Hello guys, good morning. So I'm back after a few weeks to keep you updated. So the thing is, we have witnessed this morning, right? As of 5th of August 2024, the markets have started to plunge and correct. Nifty correcting by more than 800 points and Sensex correcting by more than 2000 points. And NIKKEI has fallen down by a huge 4000 points, right? And the same impact can also be witnessed in the US markets per se when they open. Correct. And the major reason for these things, like people have been panicking and they've started to sell off their holdings. But the one thing we need to understand, and I've always insisted the people who are the long-term investors in the market and not the traders, if you're sure about the fundamentals of the company, right, or the macro conditions of your particular market, you need to be confident, you need to have faith upon your own stocks, right? Only in that scenario, you'll be able to make more money, because investment is not meant for 1 year, 2 years, 3 years basis. It's a long run game. It's a game that helps you to earn money. So keeping money for 5 years, 10 years per se is ideally called as an ideal investment period. Correct. So do not panic if you have picked up good fundamental and quality stocks. But here we need to understand that why the market has started to plunge. There's a concept called as carry trades. And we have seen the reversal of carry trades recently. Right. So firstly, we need to understand that what do we mean by carry trades. So carry trade is something, for example, so borrowing in a currency which is a low yielding currency, or a currency that gives you a lower interest rate as compared to the other currencies, or a weaker currency per se. So borrowing in a weaker currency and using that amount as a funding base, right? So using a weaker currency or a low yielding currency as a funding to fund your investment into a high yielding currency, right? So for example, if I borrow something in the Japanese yen, because earlier the Japanese yen's interest rates were close to 0%, right? So borrowing something in Japanese yen, because Japanese yen has a very low interest rate, almost close to zero. Now the rate of interest have risen to 0.25%. But hypothetically assuming that borrowing something in the Japanese market at a very low interest rate and using that money as a fund. So funding something in a country having a higher interest rate, be it US, be it Europe, right? And funding your investments there, buying a property, buying stocks or anything. So investment can be defined in terms of buying a shares or a fixed income security or simply a property or real estate, right? But quite recently we have seen the interest rate in the Japanese market have risen to 0.25%. The Japanese currency yen has appreciated by more than 2.5%, approximately 3%, and the USD has fallen. Why? Because there is an expectation about the reduction in the interest rates by US Fed. Correct? So that is one thing. So rising in the Japanese yen because the Japanese yen getting stronger, and the reduction in the value of the US dollar because of the probability or the expectation of the reduction in the interest rates, right? Because earlier Japanese yen used to be very weak, right? Hence people used to fund their investments into a low yielding currency and buy something in the countries like US, giving you a higher yield. But now the vice versa has started to take place. The Japanese currency is emerging stronger because the Bank of Japan has increased the interest rates, making the currency much more stronger as compared to the previous part where the yield was just 0%. And the US Fed and the US interest rates falling down, making the currency weaker. So hence the expectation of the US interest falling down is making the currency weaker. The vice versa scenario has taken place, right? So now this unwinding of carry trade has taken place. So all those trades that were entered by borrowing something in Japanese yen and selling and buying something as a funding tool into some other markets having higher yield have started to reverse. And that's not only happening for US, right? Because in US we have seen the tech stocks have not given a good quality result. The results have still been good, right? But the results have not been meeting the expectation per se. And the various IT companies in US have started to see again a period of recession, a downfall, employee cutting. Like companies like Intel have started to lay off employees, like more than 15,000 plus employees in companies like Intel and the other companies. The unemployment percentage has risen from 3.8% to 4.2% per se, like over the last 2-3 quarters. The jobless claims have started to rise and the fear of recession is again in US. So that is one thing. But all these concepts of carry trade is not just applicable to Japanese markets and US markets. Even the funding was done in the Indian markets as well, because Indian markets have really outperformed the other developed markets and emerging markets in the previous 1.5 to 2 years. So all these carry trades were also getting funded, and that is the main reason why the impact has started to come in the Indian markets per se as well. So that is one reason: the carry trade, the unemployment rate, the number of jobless claims. So all these things are impacting the markets. But if you are sure about a quality and fundamentally strong stocks, feel free to keep invested, because this is a time where you guys can buy on dips. Thank you, guys.